Jason, what do degenerate yield farms and exchange traded options have in common?
I don't know.
Watch this episode. You might find out.
I thought you were going to have a dad joke.
No, not this time. Okay, now before we begin, I need you to appreciate this mug.
Oh my God.
I found this, I'm renting this place. I found this in the cabinet and I've just been using it every day. It feels ridiculous, but it holds a decent amount of water.
I think it's a sign. I think you need to buy the place now.
Absolutely. All right, we're gonna start with story time. We're gonna rewind the clock. Like, I don't know, a week ago, maybe less than that. Things move fast in crypto. I feel like something happens and 24 hours feels like a week. So I am involved in a whole bunch of private Discords and Twitter groups and all that sort of stuff I've been invited into, which has been really fun from someone in traditional finance to observe what's going on sort of with some of these people who are moving markets and creating protocols and really trading in a very sophisticated manner in crypto. And I would argue, in some ways, it gives me a bit of an informational edge because there's a lot of sharing of, hey, have you heard this going on? Or, hey, saw this on chain. What do you guys think about it?
I heard from somebody who heard from somebody. No, Alex, no. Sorry. Benny Klieger over at
Morgan is taking on some heavy losses in the bond department. Might be time to get a life jacket and get out.
I mean, seriously, I feel like I'm financially inside of you or something.
And one of the things that I heard very early on was that Arbitrum was opening. You could now bridge your Ethereum over, and that there was a farm over there called NYAN. Now, hold on for a second. So for those who don't know, Arbitrum is what's called a level 2 chain. So basically, it's trying to build on top of Ethereum and be able to operate at lower costs, much faster, much more scalable, but all of it eventually pushes down to Ethereum. So the idea here was that people were going to bridge their money over to Arbitrum, but then there was literally nothing there. There was nothing to do. And so I guess someone decided to create this farm called NYAN. And you could do three things. You could stake your Ethereum and earn NYAN tokens. You could provide liquidity to the Ethereum NYAN pool and get paid NYAN tokens for that, or you could stake NYAN tokens, and again, you would earn NYAN tokens for doing that. Now, for those who don't know, NYAN is based on Nyan Cat. I don't even know if I'm saying this correctly, which is like, if it's a piece of internet meme history that's like a cat flying through space with a rainbow behind it. I don't know if you have any idea what I'm talking about. The large point here is this token did nothing. There's no development roadmap. It has zero meaning. This is legitimately a trading sardine.
It sounds like a get-rich-quick scheme.
Yes, thank you. You will get rich quick. We all will.
And yet what I knew was that the contract had been verified, that there was no exploits. Someone I knew the developer and could vouch that this wasn't going to be a rug. And there were a large number of influential parties that were starting to move their Ethereum over. So I said, I'm in early. I'm going to move my Ethereum over, stake my Ethereum, earn some NYAN tokens. And my hypothesis was basically all the large players were going to play nice until the price had pumped sufficiently, and then it was going to be every man for themselves. So I get in, I stake my Ethereum, I start earning NYAN token. Mind you, we're talking thousands of percent APR here. So it doesn't take long to start earning some value. And price started moving probably within 24 hours. I think I got in around 60 cents to like $3.50. And I said, tidy little profit. I'm going to sell my NYAN, and that's going to be the end of it. And that was mistake number one. We'll come back to why that was a mistake. So later I'm looking and I'm going, you want to know what? It was probably not the right move to actually get out. I'm going to get back in, but instead of staking ETH, I'm going to partially stake ETH, which the yield had gone way down, but I'm also going to provide liquidity in the liquidity pool. Now, the way to think of a liquidity pool is it's basically a 50-50 portfolio, in this case, half Ethereum, half NYAN, that's constantly trying to rebalance back to 50-50. And so if one of the tokens goes down, you're going to keep selling the other token to keep buying into the loss. And so when you're in a liquidity pool and one of the tokens goes to zero, you're going to lose 100% of your money. Very risky, not the smartest move. Probably had a beer before I made that decision. But I took way less capital, put it in that pool, and then, saw the price pump up to $6 or $7, and then decided to go to sleep. Again, big mistake. Woke up, it was $2.50. So it had fallen $5 while I was sleeping. Of course, there's no way for me to create a stop loss for this. Sold out, walked away, and all said and done, I ended up losing money on this trade. Now, I had some other thesis that if you're early to bridge over, you might get some airdrops as being an early bridger. That often happens. There's some other farms that were popping up. I think probably 5 of the other farms that popped up ended up being outright rug pulls. I sort of just stuck with NYAN. Long story short, I think I was right on the idea, right on the initial play. Second play was probably a little too risky, but I think where I really messed up was position sizing. And that's where I come back to this: what makes a degenerate yield farm similar to a exchange traded option? And I think the answer is, if you get in at the right time, there's a tremendous amount of convexity, and position sizing is going to matter.
Very fair. But you didn't give me the punchline. What was the original position that you monetized at 5 to 6x? Where is that now?
Oh, I lost money.
Oh, that was part of the losing money. All right. I got,
oh, yeah.
There are so many pieces to that puzzle. I may have missed that part.
Yeah. So I took, so you got to think of it as I took my Ethereum,
right,
and I staked it, and I earned some NYAN token. And then I monetized that NYAN token. And so I was getting basically, when you're staking and earning yield, it's sort of like DCAing in. So price moved from 0.5 to 350, sold that big chunk around 350, and then got too greedy, went into the liquidity pool, and then went to bed massively up, woke up massively down.
And it's gone.
Okay, so that's what I missed, is you moved all of those profits into the liquidity pool.
Yep.
Yeah, so this gives us great discussion. So
all those profits and some of my original capital.
Of course. Isn't that how it works too with a lot of hedge funds, right? It's what is the dollar average return, right? They raise a ton of assets after a big win, and then those assets go into a drawdown, but now overarchingly they're down on the actual dollar base, capital that was put in. So let's start with crypto, and then we'll bring it back maybe to the convexity of dealing with options. One is, one way to monetize is obviously tranching, right? As you're hitting exponentials, maybe you're selling off portions as you go, right? Another thing to think about, I think a lot of times, is you could just monetize your basis, right? So as soon as you're up a certain amount of X, you sell that position off, so you recover your basis, and now you're on a free roll. What I think is interesting when I say free roll or house money, if you think about traditional financial literature or even behavioral economics, tell you that's illogical or irrational. There's no such thing as a free roll or house money. But this is maybe one of those other areas where they're wrong, especially if we think about ergodicity economics. And so you brought up DCA, dollar cost averaging. And so historically, when you look at an investor going into the stock market, let's say an index, S&P index return, they want a dollar cost average in, but then all the quants come and tell them, actually, you could just put all your money in, and over the long run, you're just fine. But what that's missing with ergodicity economics is you have a personal path dependency, and your path dependency is going to be very different than the ensemble path dependency of everybody over the long arc of history. So in that sense, you're actually much more rational to dollar cost average, even though the quants are telling you that's irrational. So if we're dealing with something like trading sardines like crypto, when there might be no there, to take your basis back out and then be on a free roll, I think is a very prudent way of looking at it. Similarly, of tranching those exits at certain multiples is also maybe a prudent way of looking at it. I think it's fascinating because, you know, from let's say 2015 to 2017, I monetized the 10x like on Bitcoin, right? And then I'm free rolling after that, you know, into Bitcoin and other coins. But everybody, you know, when it was up 100, 200x, they're all making fun of me. But once again, they have paper gains. They haven't monetized. So in the long arc of history, I want to go back and see how many people actually pulled out a 10x profit off of Bitcoin. And so it's difficult because going back to, we want to let our profits run, but taking a 10x return or a 3, 5x return, it's hard to go broke that way. But people are like, but it's the regret minimization that you're worried about, right? Like you were up so big and then you wake up down the next day. It's really a regret minimization technique. And I'll stop there instead of keep babbling before I talk about like thinking about options trades and the correlation there.
I think especially when you're early in some of these yield farms, right? This isn't true convexity in the sense that we have a convex asset like an option. But I think basically when you're buying in early, there's only so much you can lose, which is the premium you put in. And you can see some of these tokens go up 10, 20, 100 times. So in terms of, if you think of it as I'm playing a lottery ticket that I think people might ape into this coin, just trying to catch the momentum. And if I get in early enough, there is some tremendous upside there. The thing, and I see this with a lot of people, and this was the exact mistake I made, is I was taking black or white positions, right? And I wasn't taking shades of gray. And I think when it comes to monetizing convexity, often shades of gray can be a way to keep yourself out of trouble. So instead of selling everything, I could have sold half and left half to run. When instead of leaving my position open overnight, I could have monetized half and you know, staked it in the safer Ethereum pool while I was sleeping. And yeah, I might have missed out on some gains, but on the other hand, I would have protected myself from some losses. I think one of the things that's interesting here that probably didn't register for me until after was the recognition that as this pool was starting to exhibit those momentum characteristics, the potential convexity was probably going down, right? Every marginal dollar coming into the pool was having less and less effect upon the price. And so unless we were going to see just money pour from Ethereum into this level 2 chain, there really was a less convex upside and more of a linear upside as time went on. And so what that means is you also have a more linear downside, right? And so there's probably a greater, as time went on, a greater peak to trough drawdown risk that was going to be realized than my initial position in the pool. It actually reminded me a lot of dealing with NFTs when I was trading those so long ago, a month ago, where if you got in at the original mint for some of these projects, again, if you identified big players who were buying them and you knew there was going to be some momentum behind the name, there was a lot of potential upside. So you're paying a fixed premium to get in at the mint, and then there's this massive potential upside of social momentum and just pure bubble speculation that you could ride. One of the things I found was it was very hard for me to manage positions because a lot of times I made the mistake of just buying one or just minting one. And so my decision was therefore very black or white rather than having the ability to scale in or scale out. And so this month, as I've been playing NFTs, I've actually not really bought any individual NFTs. I've actually went out and I've bought the tokens that are associated with certain NFT vaults. And so these tokens trade with the floor value of the NFTs. And because I have thousands of these tokens, I can operate in a gradient and take profit as it comes up partially, you know, reduce my position size to manage risk. And I don't have to deal with these illiquid, you know, JPEG markets.
I think the irony here is for all the pros and cons of like behavioral finance, like Danny Kahneman they were asked him, you know, you've been studying all of our cognitive fallacies your whole life, you know, have you gotten any better? He's like, no, I still fall for all the cognitive fallacies. So my favorite part is the guy that's known for timing your ensemble risk or rebalancing risk, you know, to use gradations and to use all of that. Like when you got into crypto, you did the exact opposite of everything you've written about over the last decade. And so
There's a reason I don't trade discretionarily for my funds.
So that's what I'm saying. You always try to talk about, spreading out your luck, basically, is a better way of looking at it. But there is a point where it breaks down to the convexity of, say, options, right? So the issue is with crypto or NFTs is you may have an infinite duration asset, or it can be a tomorrow it's gone asset. So you don't really know the duration of that asset. But when we're trading options, which makes it tricky, is you're buying a tenor, right? You're buying a time frame, and you have your theta decay. And so there's a lot more trickier decisions to be made, but it's very similar to what you're talking about as far as like volatility, mean reverts and volatility clusters. So volatility spikes are usually followed by dramatic volatility mean reversion. And so you have to have all these different monetization heuristics to try to capture as much of the meat of that move as you can. So, I mean, people use anything from time stops and rolls to like tranching, like I was saying before, or even selling out and then moving to other proxy assets, which then create basis risk. So it's just almost as difficult as what you're talking about as well. But I do think it's interesting that the convexity, to put a finer point on it, when you reach peak convexity, what happens in options, that's usually at your strike. So if you're buying deep out of the money put options, the sell-off happens. As soon as you touch that strike, that's your highest peak of gamma. So if you're looking for to monetize that convexity perfectly, not saying this is the best way of doing it, but you would monetize at the strike because that's peak gamma. Because to your point, as you move past beyond that strike, you start to transition into a delta one position, becomes much more linear, which is good and bad because your starting point is still highly convex from your starting point, but you're now exposed to open profit risk and mean reversion. And so that's where there's a lot of correlation there, but then it takes a different turn or tact when you start thinking about tenors and theta decay.
It reminded me a lot of my podcast I did last season with a gentleman named Jeffrey Baird. He's a portfolio manager at Merit Point Partners. He trades volatility in the commodity complex. And he talked very specifically about managing risk as a peak to trough number. And basically saying the weird thing about trading options is that when you are correct, at least correct, not from a volatility standpoint, but correct from a directional standpoint, you lose all the convexity and your risk goes up. So to your point, as that strike goes from deep out of the money to at the money, the risk becomes much more linear. And so what he would have to do is figure out ways to reconvexify his book and take those profits, and not just take some of those profit because he wanted to take those winnings off the table, but take some of those profit because the true risk metrics of his book had changed. And it's one thing when you're trading these for yourself and you can say, I got all the profit and the run up and I can treat it as house money. I don't think that's the right way to think about the world, because you should always sort of, at this point in time, say, what's my optimal portfolio? But it's made that much more complicated when you talk about having an open-end fund. So if you run, say, an ETF or a mutual fund and you buy options, and those options have moved from deep out of the money to closer to in the money, and then someone allocates to the fund, the risk they are taking on is much more linear than they probably thought based upon the strategy or fund description. And they didn't get any of that beneficial run up of being in the position. And so you have to be very careful about constantly looking at, when did my convex position become profitable and therefore likely more linear? And what has that done to my risk profile on the downside?
Like everything, it's the price you pay, right? Like everything is dependent on the price you pay, and that is going to determine the convexity, right? Did you come in after the flood? Did you want insurance after the flood, or are you coming in at a low point and you have max convexity on? And so it's dependent on that price you pay. I wonder, you reminded me of other collectibles, and this may be a bad analogy, but back in the day we used to buy cult wines, right? The idea was you buy a 3-pack, you sell one to keep for yourself. You sell one, flip it in the secondary market to kind of cover the cost of the 3, and then you open one to enjoy immediately. So it's once again rebalancing that timing luck. But the problem is that you referred to is like, okay, maybe I need to do that and I need to buy a bunch of NFTs, but if they're selling for 5 ETH each, not a lot of people can afford that. So I think your point is apt, that maybe you use the index of ETFs and then you can trade that as a gradient. So you may not actually hold the individual ones, and you can toggle between owning 3 to 7 to back down to 5, but it gives you some sort of option of using that gradient? Is that do you think that's the best possible trade for most people, seeing how they can't afford to be buying dozens of 5 ETH or above, bathing apes, etc.?
Absolutely. I mean, for most people, crypto punks and Bored Ape Yacht Club are completely right out of their price range. Like you're not going to pay $30,000, $100,000, $1 million for a picture on the internet. Most likely, most of us won't. But there are these fractional tokens that allow you to play the gradation. I'll admit there's another side of it, 2 other aspects that I think are really important. So I own a couple Pudgy Penguins, which is a very popular project. The ability when you have the tokens is that there's an immediate liquidity that you have access to in a automated market making liquidity pool at SushiSwap. So if you buy the Pudgy Penguin tokens, you can get liquidity to exit at any time. If I want to exit the actual NFTs I own, I have to post them on the secondary market and hope that someone buys them. And if the floor is moving away from me, I might have to keep repricing and repricing, what my ask is to try to get someone to actually buy. And that can be difficult. The second part is purely emotional. Once you buy a picture, you might actually get attached to that picture. These Pudgy Penguins are pretty damn cute. I won't lie. I can't figure out which one to sell. That doesn't happen when you're talking about coins. So I think not only do you get the benefit of better fractionalization, better liquidity, easier position management, but it takes away a lot of the behavioral bias of owning the art.
I was just thinking I showed my Gen X age because I went right to Bape, the Japanese clothing company, versus Bored Ape, because that's all I think about every time. But I think circling back to even the beginning of our conversation, I found it fascinating that what you're really doing is this is game theory or a prisoner's dilemma writ large, and you're trading it in real time. So that's the feedback I find fascinating, is like, at what point are you, or as Keynes talked about the beauty pageant, right? Not who's going to win the beauty pageant, but what are people going to vote on that's going to win the beauty pageant? And you're trying to game theory that out of like, how long am I holding? But that doesn't ever give you any sort of comfort and rational expectation of when is a good time to sell.
I will say, in my experience in a lot of these discussions in the private Twitter groups and Discords, the one pattern of fact that I have seen is the people who were most successful in August with NFTs were people who minted a lot and had a lot of a lot of pictures and that they could sell, gave them a gradient to monetize. And the general heuristic seems to always be, as quickly as you can monetize to get out your initial capital and then let it run. Because I think a lot of these people, they're experiencing crypto in particular, is things can get a lot crazier than you think they can. When I talk to people in equity markets who are trading equity options, I think the monetization heuristics are a little bit more reasonable. It's not wait for a 50x, it's wait for a 100% and then maybe a 200 and 500. There's all sorts of monetization rules, but I think in crypto, these people have seen things go 20, 50, 100x. And so holding on to just a little for that outsized opportunity can make sense when there's such a fat right tail.
Let it ride. Pudgy Penguin needs a new pair of shoes.
I am never going to financially recover from this.
Now make sure you like, subscribe, and hit that notification bell so you never miss one of these amazing episodes.